7 Rules to Quickly Get Rich, Warren Buffett. Investors may bet on 20 great ideas in their lifetime, assuming they will make money, but this could be a mistake. 3, 5, or 7 may make you wealthy, according to Buffett, but you can't get rich by trying one new idea every day. The Buffett rule of rejecting most good ideas in favor of 1 or 2 truly great ones is a life principle that applies to all aspects of life, not just finances or investing. It forces concentrations which Buffett is used to. In today's video, we're showing you some rules by Warren Buffett to quickly get rich. Are you excited? Here we begin. Be willing to be different. Refrain from making decisions based on what everyone else is saying or doing. When Buffett started managing money in 1956 with $100,000 from a few investors, he was labeled an oddball. He worked in Omaha, not on Wall Street, and refused to reveal where he invested his partners' money. People predicted he'd fail, but 14 years later, when he closed his partnership, it was worth more than $100 million. Ben Graham, the father of value investing, used to say that you are right if your facts and analysis are correct, not if other people agree with you. As an investor, you must think independently, which means you must be willing to be unconventional at times. Reinvest your profits. You may be tempted to spend your first earnings. Reinvest the profits instead. Buffett discovered this early on. Warren understands the value of compound interest. If you have a $1,000 investment that earns 10% per year, you will be paid $100 in cash every 12 months. If you spend that money, it's gone forever, and you'll always earn only $100 per year. However, if you can reinvest that money at the same high rate of return, then in 2 years, you will earn 10% of the $1,100 rather than $1,000, which means you will be paid $110 rather than $100. This disparity grows exponentially over time. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett is a value investor who seeks out high-quality stocks at bargain prices. His true goal is to increase Berkshire Hathaway's operating power by investing in stock that will generate consistent profits and capital appreciation for years. To pick stocks wisely, investors must establish criteria for identifying good businesses and adhere to their principle. For example, look for companies that provide a long-lasting product or service with solid operating earnings and the seeds of future profits. You could set a minimum market capitalizations and maximum price-to-earning ratio to debt level that you are willing to accept. The ultimate goal is to find the right company at the right price, with a margin of safety against unknown market risks. If the business does well, the stock eventually follows. Buffett was convinced by Benjamin Graham's book, The Intelligent Investor, the British-born American economist, professor, and investor known as the father of value investing, that investing in a stock equates to owning a piece of the business. So Buffett looks for companies with promising long-term prospects when looking for a stock to invest in. Buffett only buys something if he can write down his reasons for paying a certain price per share for a specific company. It is recommended that all investors follow suit. His favorite holding period is forever. How long should a stock be held? Buffett believes that if you are not comfortable owning a stock for 10 years, you should not own it for 10 minutes. So, Buffett held on to most of his portfolio even during the period he referred to as the financial Pearl Harbor, unless a company's prospects have drastically changed, such as impossible labor problems or product obsolescence. A long holding period will prevent an investor from acting too humanly. Too much fear or greed can cause investors to sell at the bottom or buy at the top, destroying long-term portfolio appreciation. Never lose money. Buffett personally lost approximately $23 billion during the 2008 financial crisis, and his company Berkshire Hathaway lost its prestigious AAA rating. So, how can he tell us that we should never lose money? He's referring to a prudent investor's mindset. Don't be careless. Don't take chances. Don't enter an investment with the mindset that losing is okay. Be well informed. Do your research. Buffett only invests in companies that he has thoroughly researched and comprehended. He does not enter an investment expecting to lose money, nor should you. Buffett believes temperament, not intellect, is the most important quality in an investor. A successful investor is not concerned with being with or against the crowd. The stock market will experience ups and downs, but in good and bad times, Buffett remains focused on his goals, as should all investors. As a result, this renowned investor rarely modifies his long-term investment strategy regardless of market conditions. Know when to quit. Buffett once went to the racetrack as a teen. He lost a bet on a race. He bet on another race to recoup his losses. He lost once more, leaving him with almost nothing. He felt sick because he had squandered nearly a week's wages. Buffett never made the same mistake again. You don't have to get it back like you lost it. If you realize that your original investment thesis for a particular stock is no longer valid, it's time to sell and move on. Find the next best investment opportunity and invest in it. Many startups in Silicon Valley live by the motto, fail fast. If you fail, you should recognize it quickly, learn from it, and move on. So, this is all about some rules to get rich quickly by Warren Buffett. What do you think of these rules to get rich quickly? Let us know in the comments below.